year. It's been such a topsy-turvy financial year, COVID, Ukraine, elections, lots of ups and downs, oil shock, oil prices going through the roof. And then we are also 4 weeks into the war in Ukraine, which has changed the geopolitical scenario in more ways than one. We have talked about the impact of that on the Indian economy, what it has done to prices, the oil prices, inflation, what RBI needs to do when it meets again, the Monetary Policy Committee meets again early next month. But we are not going to again repeat those points, but we are going to sort of look much more further into the next 12 months and beyond. What is the impact of the changes we are seeing? The war right now doesn't look like it is ending anytime immediately, but it can't go on forever. It will have to end at some point of time in a few weeks, if not a month, and then that will have repercussions. And one of the repercussions which Professor Ila Patnaik has written about in her column today is that there is a great opportunity going forward for India in these realignments. And that is the focus of our episode today, the last episode of this financial year. Hi Ila, good to be back in the studio after a couple of home Zoom episodes. I know it's people will say these people are talking about opportunities when there is war and people are suffering in another part of the world, but there is realignment that will eventually happen. And you say that there is opportunity for India. But before we get there, what has this geopolitical turmoil done to the way the world looks at investments, countries, safe havens, risky places?
See, in this column, we have focused on what this war means for foreign capital flows to India. Now, what it has done is it has made emerging economies riskier in any either great periods of great uncertainty or periods of war or the taper tantrum or the global financial crisis. The first thing that we see that happens is a risk-off situation. And that is that capital flows, foreign capital flows, the liquidity that is, washing around, sloshing around in financial markets across the globe, they tend to go back to safety. And this back to safety typically means that they leave emerging economies and they go to, say, the US or advanced economies. And that's the first thing that we notice, that's something that will happen. Now, here in India, even before the war, actually, after the Fed announced that it was going to tighten, we saw capital going out. Right. So in the immediate context, war, uncertainty, the fact that we have a large current account deficit, the fact that we are an oil importer, the fact that we have ties with Russia and trade with Russia, and that the US is threatening sanctions for countries, even those who trade with Russia, there is a lot of risk, and it could mean that we could get very gloomy about capital flows. So that's the current situation.
And this is a temporary phenomenon according to you, but how temporary could it be?
See, I am not trying to say that I know when the war will end. Yeah, so how temporary is not something that, we all want to be optimistic and think that the war will end very soon, but nobody really knows. But I think temporary because this could lead to a realignment of resources or realignment of forces in the world where already we see some of that happening. So we've seen FDI get out of Russia and become increasingly unhappy with China. So what we are saying here is that given that, what has happened now, in the long run, out of the capital that comes to non-developed world, can we get a bigger share? So countries that were going to Russia, that were going to China, don't like authoritarian regimes because of the kind of things that happen, would prefer a peace-loving, democratic country. And then, of course, we need to get the conditions right. if we want to attract a bigger share of that pie.
I would like to quote from your piece, which was published in the print today. This will be on the print.in and also in the notes of the show. You say once the war is over, among other factors, India can be seen as a more attractive investment destination as it is a democracy. In addition, India is geostrategically placed to be a counterbalance to China in this region. And India is working towards improving the environment for investors, and further reforms will help make it more attractive. And then you go to list a couple of key points here, and I'll just touch upon them. One is, you said foreign investments have already been robust in the last 7 years compared to the last 21 years. The last 7 years have been the best.
Yes, so we've actually seen a lot of foreign investment coming in. While, there's always this sense that people have that, a lot is going to China. But if we look at our own performance, then you do see a robust increase. And, whether it is in startups, whether it's in portfolio investment, whether it is FDI, whether it's FDI in services, not just in greenfield manufacturing, but FDI in services. There's a lot of FDI flows that have come, FII flows that have come, and that's encouraging.
And fund diversion from China is something we've talked before also, that China plus one strategy a lot of countries are adopting in the aftermath of the COVID disruptions, the supply chain disruptions. The next point you make is policies to liberalize FII investments. That has been a significant development in the last few years.
Yeah, so if you look back there, say 10 years ago, in fact, Radhika and I, who've done this column, had written a report for SEBI, where there used to be caps, quantitative caps on the amount of investment in government bonds by FIIs, rupee denominated. And where we had argued that this was a study which was trying to look at what can be done, and we were arguing that, look, this is rupee denominated, and so the risk is low. The risk is, of course, capital will go in and out. It does, so it could sell if you create macroeconomic instability. But in terms of the currency risk, this risk for the government of India is low, and we should open that up. Over the last decade, we've actually seen a lot of this opening up happen, and we've been talking about India's inclusion in the global bond index and what needs to be done. Of course, it's not all done yet, but there is talk, there is progress, and it has been liberalizing. The regime has been liberalizing.
And the other big headline from this week, which you have mentioned, is exports.
Yes.
Record $400 billion even before the financial year was over. Although again, we have talked about how this has been helped by the global demand in the aftermath of the pandemic, the commodities boom. But still, that's a foundation India built last year.
Yeah, so $400 billion was, I don't like to call it a target, because it's not as if we are doing 5-year plans and we have a target, but that mark of $400 billion, it has been helped, of course, by petroleum, because we export petroleum. About 15% of our exports are petroleum. It has been helped by wheat, because Russia, Ukraine, are big wheat exporters, and so we are replacing them in terms of wheat. But even in engineering goods, even in other commodities, we have made headway. Now, of course, if we were part of, if we have trade agreements, if we were part of RCEP, or if we were doing more of becoming part of global supply chains, which are all aspirations for us, which will hopefully will become part of global supply chains, and this will get better. So, but the policy environment has to be supportive, and we shouldn't try to make the rupee too strong. So
that is something we talked about in the last couple of episodes. The last point you make, Ila, is commitment to reducing carbon emissions. That's a new one. That's 21st century investment frameworks. Why is that important?
So increasingly, a lot of institutional investors are telling their fund managers ESG, okay, that they want to put money into, of course, there are other objectives as well other than carbon, but carbon reduction, carbon emission reduction is one of the big objectives. A lot of the infrastructure projects that come now from almost all MDBs, really the money comes if you have, they assess and they see what the carbon footprint of your investment is, and then you get the money. A lot of the money comes associated or riding on top of the MDB money. MDB is the Multilateral Development Bank. So on top of the MDB money. And that is also then looking for a country or a project rather that has committed to, they look at the impact, carbon footprint, and they look at the impact, and there you gain. So I think one of the things that we need to do, and we have started, but that we need to do, apart from being democratic, apart from being a peaceful country with social stability and with rule of law, apart from all of that, we also need to be committing to reducing carbon emissions, and that will help us get more foreign capital flows.
And that commitment has been made. There is a net zero goal, although people say that goal is too far in the future, but
we'll start moving towards it. We are a poor country. Our per capita emissions are low. There are issues. We need investment.
Yeah.
The thing is that there is an opportunity to get a lot of that investment.
Yeah. So, last point before we take questions from our viewers. Everybody says, oh, the print is always gung-ho, they are always very positive, but there are so many, downsides. There are a lot of, they don't talk about it, so, I'm going to bring it up and talk about it. There are some boxes India still has to tick, the government still has to tick for, making all this work. It's not just that, the world will come and say, take this money. Absolutely. India has to have a strategy. For example, we have to have standards let's talk of the last point. We have to have standards where we say, okay, this is what this project is doing, and that should be bodies that should be able to certify that the carbon emissions of this project are low, or that this is something that can be flagged as. So we are going to do these green bonds, and we'll have to show that the money borrowed there goes into infrastructure projects which are such that their carbon emissions are low. We'll have to do all of that. We'll also have to have regulatory regimes that are friendly. We've taken a long time to set up the gift city, for example. Although it's still a work in progress.
It's still work in progress. All the regulators have to come together to agree not to go after foreign capital. We also have to have a better tax regime. So, this is not to say that we are at the destination and everything is there, but this is to say that, look, there is an opportunity, and if we get it right, if we check all those boxes, whether it is reducing carbon emissions, whether it is a better regulatory regime, whether it is a more rational and simple tax structure with more tax stability
and predictability,
a stable, predictable tax regime, all of those would be important factors for whether this actually happens or not. And all we are saying is that because of our being a non-autocracy, because of our being a democracy, because of our peaceful nature, because of the commitments that we are willing to make, because of the much more transparency that people see here, in contrast to Russia and China, after this war, we could become an attractive destination.
Hopefully. Questions from our viewers. Hang on, there's quite a bit already. Vaibhav Rastogi is the first questioner. It's about inflation and commodity prices. Okay, what is your view on inflation as commodity prices are soon going to beat the developed Western nations? I mean, I will try to read.
There's a whole.
I know.
I mean, so just for the viewers, if you, you look back, we've done an episode on what the present global conditions and the Ukraine-Russia war have done for prices, commodity prices, currencies, monetary policy, and now we are on capital flows.
Yeah.
So, you
Focus on it's all
others,
there
and
on
let's
our YouTube channel.
Absolutely.
But I will try and rephrase this question to fit in with our current topic, Ila. Do you think inflation can be a deterrence for investors?
So inflation, if it is high, if it is unstable, volatile, high and volatile inflation is a deterrent for all investors everywhere. So if you want to invest in a country where you don't know whether you'll get any return or not, hardly anyone's going to say yes. So yes, absolutely, it's a deterrent.
Okay, Aditya is asking about tax cuts. Sorry, Aditya, we're not dealing with tax cuts in this episode. Again, Aditya is asking about, can we hedge our oil purchases so that we don't face issues of oil prices in global market? I mean, how do you hedge oil prices? You can only keep some stocks and hope.
ONGC has bought oil fields in Russia. Now, what do?
Exactly.
It's a very difficult situation.
Yeah.
You can't trade with Russia, and of course, the government is going to try and set up a bank-to-bank relationship. RBI is already talking. But, there are all these issues which are not simple and will need to be addressed.
Ankit is asking about exports. India recently crossed the 400 billion mark for exports. Will this boom last longer, or is this just short pent-up global demand?
So there is, of course, pent-up global demand. But again, think of the opportunities. If you do get your act right, then one thing that's going to be important is your rupee policy. And we talked about this last time. Don't try to defend the rupee, keep it strong, because at the end of the day, then when it crashes, the crash is going to be big. So you don't want to create uncertainty by interfering too much in the direction in which the market is going. So that's one part. And of course, you have to have, a regime which is friendly. You have to have taxes which are friendly for exports. You have to have be part of various regional and bilateral trade agreements. In fact, reduced tariffs always help exports. So while reduced tariffs, higher tariffs might help some industries protect themselves, but when it comes to exports, it's always countries which have lower tariffs, which can become part of global supply chains. And so, yes, there are many policies that we can follow so that this boom becomes a sustainable boom.
PK, who's been a member for 6 months, has a connected question, although I don't know what the connection between exports and inflation is the $400 billion export due to inflation rather than actual growth, as export to GDP ratio has actually gone down?
No, so 400 billion is in dollars.
Yeah.
$400 billion. So when you are talking about it in rupees, then I think that's what you're thinking. You're thinking it's rupees.
Yeah.
Yeah, he's thinking it's rupees, and that's why he seems to be thinking that it's the rupee value which is high because of inflation. To some extent, of course, because of oil inflation, which we've already talked about, the value of oil exports is high. So we import crude and pretty much just refinery, and we export
the one big refinery on the west coast.
Yeah.
Aditya has a question on cooking oil and sunflower oil. As the war has been going on for more than a month now, what is the impact on the prices of cooking oil, especially sunflower oil? Will this lead to WPI finally hitting double digit if war goes for another month? WPI has already hit double digit. Maybe he's confused between CPI hitting double digits.
Yeah, so do watch the last episode. We discussed all this in the last episode.
This is the next one is Bhavansh Gupta. Uh, Again, what is the impact of Russian demand for ruble payment for its natural gas? Will it hurt our dollar reserve status? No. Aurelio Ray, Tesla will not invest in India. Who is looking to build its gigafactories in the world? And taxing its electric vehicles very high is so backward. We've talked about this also.
Again, yeah.
We'll recount it for you. Sorry, we can't tell our viewers we've talked about this before. The thing is, you have to manufacture in India. What does India gain by Elon Musk bringing equipment that has been manufactured in China and assembling it anywhere in India? How does it help?
Except that it might create demand for electric vehicles if they are affordable and within the price range that people in bulk can buy them. So there is an argument both ways.
But Tesla is not manufacturing cheap EVs.
So that's the point. That if you had a situation where you first got imports which created a demand, and then that led the producer to feel that okay, instead of producing there and selling here, the producer should actually relocate the factory here. Then you also get FDI with it and you do production here. Otherwise, you basically import. EVs, as long as our power sources are coal-based, then EVs don't necessarily immediately translate into low carbon emissions for the country.
Yeah.
So this may not be the right time to, start importing Teslas.
Nitesh Jain, who's a new member. Hello, Nitesh. Indian SMEs are not able to scale up. No matter what happens, we are not able to compete with China. How can in such a scenario we benefit from the changing geopolitical situation?
Because the demand for manufactured products is not necessarily the demand for low price manufactured products as countries become richer and as households become richer. So you see this demand curve actually, you see demand actually shifting away from very low price stuff to boutique stuff. In fact, you will find, in the farmers market in California or London, or you'll find these handmade things or boutique things are actually very expensive compared to large factory-made stuff. So you may not catch that low end of the demand. China has already captured that low end of the demand. But as the demand shifts, which it is because people are becoming richer, countries are becoming richer, India could tap into that boutique market. And India is tapping into that boutique market. So small scale, niche products produced on small scale, whether it's fashion, whether it's embroidered products, whether it's leather bags, whether it's, so you will find a lot of that in advanced economies selling well, while China continues to do the low end. They dominate in that product, in that market.
We have two last questions, out of which one is something I will refer our viewer to what we did last week. Harsh Tomar, what do you think is rupee? What do you think? I'm sorry, I'll rephrase it again. What do you think about the rupee's value? Devaluation of INR will increase investors. We spoke about this in full detail last week. Only the valuation
episode was only on this.
So please go to our YouTube channel. It's there from last week. If you go to the YouTube channel videos, there is a playlist for all the Economics videos. It will be there. You will find it, Harsh. PK, a more specific question this time. Without joining RCEP, we are losing out in the big ASEAN and China markets. So how can we expect to grow without having large trade with these countries?
No, we should have large trade with these countries. So I was primarily focusing on foreign capital inflows into India, and foreign capital inflows in contrast to trade. To some extent, trade relations as well, and people who are looking for countries other than China to source products from. So that's one part of the story. But mainly, foreign capital flows come not always because of trade, but because of the environment you create for investment, taxation, and regulation at home.
Thank you so much, Ela. So that brings us to the end of this episode. We will see how things start in the next financial year. We will be back next week, next Friday, with another episode. Until then, stay safe and have a good weekend.